We had a really pretty positive, at least benign report on inflation today. And as always, you can kind of look into it, and there's some things to be kind of hopeful about as well. We've long called for an elevated inflationary rate, but not hyperinflationary. I still think you're looking at an elevated inflation rate moving forward, but a lot of this is priced in. You are seeing some kind of increased propensity for the Fed to cut rates, and you're seeing this shift daily on that. We still think that maybe potentially there are 1 to 2 cuts this year. But I think when you look at the inflationary picture, your typically highest prints come in the first quarter. January, February, and March, you tend to see some more elevated cuts. And then it kind of trends a little bit more downward for the rest of the year with a few little spikes. So you have some seasonality aspects that are starting to say, well, maybe this is going to continue. But we still think you're going to be looking at about 2.25, 2.5% inflationary rate, maybe a little bit of spikes here and there. But overall, you're looking at a picture that's going to be somewhat just sticky in general. And that just means basically that inflationary components could be increased money supply. You could see some more increase in real wages, as we saw in this print, at a 1.9%, well above expectations. But there are some pressures coming on the disinflationary aspect of it. And overall, we think it balances it out. And this print here kind of exudes that to a large degree. So in this case, the inflationary front is positive that it's steady to lower. We just think it's going to be steady moving forward. And as such, everything we look at, the markets being priced in, look positive.